today's video, we're going to see an example of price action analysis in the 1 hour time frame of the Australian dollar versus the US dollar. In this analysis in particular, you'll be able to see elements from the fractal flow strategy, the market maker strategy, and the Newtonian trading strategy as well. You'll notice how it's possible to combine these different approaches in one single analysis in order to maximize your results. So without further ado, let's begin the analysis. In the chart, you can see that I marked out 4 points. These points represent the most important alternating highs and lows in the market up until this point. Here in the fractal flow channel, we call these significant highs and lows the major flow. We also have the minor flow, which is composed by the smaller alternating highs and lows in between the larger ones. One detail about these 4 market extremes marked out in the chart is that they seem to be going sideways. When that's the case, we know that price might tend to reverse near the last market extreme. However, we have to be careful with this sort of general guideline because there is a lot of different things that can happen in the major reversal points of the market. Before taking a look at the situation in number 4, let's quickly observe an important detail in number 3. Notice that the number 3 is near the high number 1. Notice also that the absolute high in number 3 is formed by something called fractal bar, which is a pattern derived from fractal geometry. Another detail here is that the absolute high number 3 is forming a reversal divergence with a previous high in a minor flow dimension. We can see that by observing the price extremes in price action and the corresponding extremes in the relative strength index. A final and less obvious detail about number 3 is that the absolute high touches what's called a frequency line that comes out of the high number 1. We can even draw a large major Andrews pitchfork using the relevant alternating highs and lows in the chart and observe that the tip of the high number 3 touches the center line of the pitchfork with an incredible level of precision. In summary, in number 3 we have a fractal bar touching the horizontal frequency line and the center line of a pitchfork, and all of that is happening within a reversal divergence. That represents a quadruple intersection of techniques. And as you can see, price immediately reverses after number 3. My point here is that the market reversals are not random. They all happen for a reason. In fact, they happen because of a number of reasons correlate in the same point. Number 3 is a textbook example of a clean market reversal, but that's not always the case, of course. The market will throw all types of challenging scenarios for you to figure out in real time. Moving on to number 4. We have some new and interesting information to deal with. The first thing that grabs the attention is the fact that the bar that forms the absolute low up until this point has a prominent lower tail that was formed after touching the level of low number 2. In any market, that might suggest a phenomenon called market manipulation, where large traders will purposefully drive the market to certain inflection points in order to trigger the breakout traders. In this case, the situation could represent the market makers pushing price lower until it hits the level of number 2 and triggers the breakout sellers. The large number of sell-stop orders sitting in the level of low number 2 represent an opportunity for the large traders to enter the opposite position, since the cluster of orders form a deeper liquidity pool in that level. All of that is just a possibility that will be confirmed later on or not, but it's important to keep in mind that this sort of situation not only can, but happens a lot in all time frames in all markets. The reason for this is that any market naturally produces a small number of participants with disproportionately large market power than the rest of the market. It's a natural consequence of a free market environment. Similarly to number 3, in number 4 we have the absolute major low forming a reversal divergence in relation to a minor low right before it. In this case, instead of touching the horizontal frequency line, price is touching the absolute low line from number 2, which is far easier to see than the frequency line. We can draw a major Andrews pitchfork using the major alternating highs and lows, and by doing that we can see that the center line of the pitchfork correlates with the absolute low we have so far, once again showing an incredible level of precision. Even though we don't have fractal bars in here, the combination of these different elements of market manipulation, the Andrews pitchfork, and the horizontal line suggests that this might be a reversal point to the upside. The question here becomes how we can pinpoint the first pullback after price rises. There are dozens of ways of doing this, but one of the ways is to connect the frequency of the minor market extremes that surround the potential major reversal point. If we do that, we'll observe an upsloping line that might catch a pullback. However, keep in mind that this sort of thing not always works, and if price ends up touching that line at all, we still have to look for further confirmation to see if we can trust the line or not. Let's advance price action a little bit to see what happens. Here we can see that price not only touches the small upsloping line, but it also creates a fractal bar. Actually, this is a hybrid bar with buying pressure and fractal qualities. Notice also that the first leg up breaks the last minor high before number 4. All of this suggests that we have indeed a reversal point in our hands. The presence of the hybrid bar also gives us an anchor to pull the trigger to the upside. Since the hybrid bar has a significant degree of buying pressure in its lower tail, we can think about placing a stop loss order below the tail instead of the absolute low number 4. That would be a more aggressive stop. If you wanted to be more conservative, you would place the stop loss below number 4. For the target, we always want to strive for at least 1 to 3 risk-reward ratio to create a good expectancy and to ensure that we can sustain our equity curve in the long term. We can once again employ the Andrews pitchfork using the last alternating major highs and lows. The only target that can yield a 1 to 3 risk-reward ratio in this case would be the upper line of the Andrews pitchfork. So we can place a dynamic target in there, meaning that as time passes by, the upper line gets higher, and the target moves higher as well. That's a good thing because the trade will tend to reward more if price takes a longer time to reach the upper line. Let's advance price to see what happens. We can see that after price met the upper line of the pitchfork, it created a hybrid bar once again with the fractal and selling pressure qualities. This bar becomes even more powerful when you realize that it also broke the dynamic frequency line of the last minor price vector leading up to the ultimate high. We can also see that happening within a reversal divergence by comparing the price action highs with the corresponding highs in the relative strength index. If you want to learn more about how to trade like that, you can check out my courses by visiting my website fractalflowpro.com. There you will find more details about the courses and testimonials from students who already are familiar with the techniques. If you enjoy what I do and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, and leave your comment below. Thank you very much for watching, and I hope to see you in the next videos. Take care.